So remember the phrase double dip, recession? I mean, that's been put to bed for quite some time, and it seems that it's back. And Erik, I don't know if I should be happy for you, but you actually predicted this, that the UK would be headed back into a recession. So there you go. Your wish came true.
I'd hardly call it a wish, Eleni. I think it's just more of the same. We've now going into our 5th year of the global financial crisis, and despite massive amounts of stimulus, which is not really to a large extent reaching the end user, the real economy is struggling to get traction around the world, although I think it's too early to gauge whether we're going to go into a global dip scenario again, but Europe especially remains in a whole heap of trouble, and I think our summary of the last 3 or 4 years that austerity unfortunately just perpetuates and extends negative feedback loops is kind of spot on.
So Erik, I mean, this is really bad news. I mean, if you're living in the UK right now, it obviously means that there could be a lot of pressure to come. So again, we are sitting in the scenario where sentiment is going to be hurt, the retail sector is going to be hurt significantly, and you were talking about austerity. What about stimulus? I mean, do you think that the Eurozone, the UK, is going to sit up and say, why not embark on a US-style stimulus to ensure that there is growth, and we'll sort out the debt later?
This is becoming a very contentious issue amongst politicians around the world, and especially policy makers. You'd recall early in April, the UK Central Bank, the Bank of England, actually came out with its fighting inflation credentials again. It actually said in its MPC statement that it would basically ignore any softness in first quarter or overlook softness in first quarter GDP data, but I think this data is probably going to surprise them a bit. I think the problem is that the amount of stimulus that's been thrown at the problem around the world is now so much that people are running out of firepower, so they need to do things differently.
So Erik, I mean, what kind of what kind of solutions can you actually put in place? And I mean, this is not only about the UK. We're seeing similar pressure coming through in Spain. We just heard that the ECB is going to assist Hungary because it needs some kind of bailout as well. This is not just contained to peripheral Eurozone. I mean, this is extending to the core of the region. And it's becoming a very scary scenario if you just look at in terms of some of the pressure that one would experience down the line if we don't see any action taken.
Look, I think 2 things. Firstly, we have to take a step back, and it really is a risk that one starts sounding like a doomsday sayer. I think the key issue is that up to now, there's been a lot of experimental policies. There's been a lot of money printing. I like to call it money printing. Some people don't. Some people get upset about it being called money printing, especially if you're a policymaker. I think the key issue is that the money is not reaching the end user the way in which Ben Bernanke in 2002 suggested, or Milton Friedman suggested, the dropping money out of helicopters. So with the money not reaching the end user is not spending, and while it looks like the consumption side of global economies is still the side that's propping up some economies, unfortunately, with bridges not being built in nowhere, etc., we're not getting to that point where economies start finding traction again. I think that unfortunately the problem with austerity and with money printing up to now, that combination has forced many economies to go into coalition politics or a variation thereof, and that leads to indecision. So everywhere around the world, the UK is a classic example. Australia just had a re-election or attempted re-election recently again. You have the left and the right fighting with one another about whether austerity or money spending is the right option. So unfortunately, no decisions will be made.
Okay, so
big
Erik,
decisions.
I would like to see what's happening in the Australian market as well. I know it is something that you are looking at, and just this week we heard that because inflation seems to be under control, we might just see an interest rate cut. And of course, I don't need to remind you, Erik, that it was the one country that didn't actually head into recession during the financial crisis. Is there a concern at this point, and should we be looking at Australia as a point of reference?
You rightly point out that I like looking at Australia. It's always been a canary in the coal mine for me. I think it's probably more looked at now than China has been over the last 10 years. And predominantly as a primary gauge for what's happening in China, because it's so closely linked to that economy and Asia in general. Australia is in a catch-22 situation where there's been a massive credit boom over the last 10 years. It's a wealthy economy because of a commodity export boom. But at the same time, also, it's had a very sound central bank and very sound policies that's protected the economy. Unfortunately, because the economy is tied to the hip with Asia specifically, any slowdown or more pronounced slowdown in Asia from here on out, which is a key risk now, especially with the ongoing troubles in Europe, is going to affect Australia more than most economies, and that is why we have a very keen eye on Australia at the moment. I think it is in the price that Australia is probably going to cut at least another 2 to 3 times, but the extent of the economic weakness is something that's kind of out there at the moment. People are struggling to gauge that, and my assessment, at least, of the Australian economy is that it's not doing as well as some headlines would make us believe.
Okay, so let's just bring it back home, Erik. Let's look at what's been happening on the bond front. 16 billion rand worth of bonds being bought in the month of April, 4 billion sold in the 9 preceding days to around 17th of April. What is your sense? I mean, obviously, net buyers of South African bonds. Can this, of course, trend sustain itself down the line?
Yeah, this is a very interesting one. I mean, obviously, we had last Tuesday, we had the very belated announcement by Citigroup that South Africa is now eligible to be included in the very prestigious WGBI index, which is basically the World Global Bond Index, and probably the premier benchmark for global bond mandates around the world. The money that we've seen flowing into South Africa up to now would in part at least be speculation that the inclusion is a done deal and that there's many tracker funds that have to invest in South Africa from here on going forward. My argument over the last, I think probably 6 years, even since my Nedbank days, have always been that South Africa is an overweight market for many of the local currency funds. So the likes of the PIMCO Emerging Market Local Currency Debt Fund has always, or pretty much always, been overweight South Africa as a constituent within its portfolios. And the likes of PIMCO will also be overweight South Africa in its global mandates. Many of these large global fund managers are now shifting to GDP weights in their allocation process rather than market cap allocations. And therefore, I think that South Africa is already owned, and I've had this argument for some time. And I think people must just continue to weigh up the global dynamics relative to a very technical, potential positive story for South Africa. Yeah. So it's not a no-brainer, just continue to buy South Africa because we're getting included in the index. There's a lot of stuff happening elsewhere in the world that can impact South Africa indirectly because it's a small open economy.
Fantastic, Erik. We have to leave it there. Thank you so much for joining us.